Good morning. It is Thursday, March the 26th, and here is what's on the agenda. Disputed Iran talks conjure the fog of war. Oil gains and stocks drop, and another private credit pain point.
Well, Tom, those mixed signals coming out of Iran and the US are weighing on futures on both sides of the Atlantic this morning. We've already seen losses in the Asian session, but this is particularly for tech shares because of that breakthrough touted by Google researchers. But the general risk-off mood comes back to oil once again. The geopolitics lifting oil to $104 a barrel today, headed for its biggest monthly gain since 1990. The countdown to the opening trade starts right now.
It seems then that we are in a he said, she said moment when it comes to these apparent talks between Iran and the US via intermediaries. But what we do seem to be getting clarity on is the complexity then, Lizzy, of reaching any agreement between the two sides. Someone seems to be looking for an off-ramp. Is it Iran? Is it the US? How you get to that off-ramp at a time when we get reminded again that the conflict continues. We've had targeting, for example, of a Turkish oil carrier in the Black Sea just in the last few hours. And the Iranians continue, they say, to double down on their actions in the Middle East. Someone seems to be looking for an off-ramp, but how we get there is a question, and markets right now taking a breather after some gains yesterday.
Yeah, to recap these conflicting signals, you've had the White House insisting that peace talks with Iran are ongoing. Iran, though, rejecting the US's 15-point truce proposal. And state-owned Press TV, it says Iran's issued 5 conditions of its own to end this war. Now, the US maintains that the talks have been productive. CNN reporting that Vice President J.D. Vance may travel to Pakistan for talks this weekend, but it isn't clear exactly who the US is talking to on the Iranian side. There's little clarity over whether Iran will immediately allow commercial ships safe passage through the Strait of Hormuz, which is, of course, the focus for traders here. And so with the ball back in Trump's court, essentially, the question becomes, what is he going to do between now and the end of that 5-day deadline? Is he going to try and woo Iran, or is he going to try and turn up the pressure? Because we know that more troops are going from the US to the Middle East.
He has that optionality. The options and the decisions are going to be complex and potentially momentous for this US president. But in terms of getting assets into the region, we continue to see that build-up of troops, reports of Marines being moved into the region, potentially 5,000. Members of the 82nd Airborne are in place to move into the region as well, and another additional 1,000 troops. The options seem to be Karg Island, potentially the land close to the Straits of Hormuz, or potentially looking to get that Iranian nuclear material. All of those would have deep consequences, of course. That is the optionality for President Trump right now as we look at the push and pull between the two sides. And again, in terms of the market's focus on the timeline, the White House saying we stick to the 4 to 6 weeks timeline in terms of wrapping up this conflict. And into that time frame, you have to put this meeting between Xi Jinping and President Trump mid-April, which suggests that the Trump administration wants to get this done before that meeting in Beijing.
And the White House Press Secretary Caroline Leavitt seeming to hint at that. Yeah. In terms of the market reaction, we've got oil climbing again today. Brent up 2.5% at $104 a barrel. We have had these conflicting comments, but oil was down yesterday because the market seemed to be latching on to this idea that, and Anna was putting this really well yesterday, I should say, Tom, that it matters that the US is putting forward a plan, no matter what Iran's response is, because you need it as a precondition. The US's willingness is a precondition, even if it's not sufficient to end the war. But also, do note, you've got traders minding what's happening between Russia and Ukraine and the risks to flows there. The interesting comments coming out of this conference happening in Melbourne. The BlackRock president, Rob Capito, saying that investors could be underestimating the risks from the crisis, and oil could spike to $150 a barrel, he says, even if the war ends tomorrow. It could go to that level. Trump officials, we report, are looking at the economic consequences of oil going to $200 a barrel. So really extreme scenarios being considered for the US economy.
$200 a barrel. What would that mean for the global economy? What would that mean for inflation? What would that mean for central banks, with markets already pricing in 2 or 3 hikes from the likes of the ECB and the Banking of England, with the Fed seen on hold? And that is not in a $200 a barrel environment. $150 a barrel is the expectation from Bloomberg Economics. if we see this conflict continuing into June. So we are starting to game plan now higher oil prices and what that will mean for inflation, for the markets and for the global economy as well. So BlackRock's president, Rob Capito, to your point, saying investors may be underestimating the risks. The moves and the action in the markets yesterday certainly seem to indicate that this is a market that is positioning for de-escalation, and we've talked about the complexity of getting to that point where things really de-escalate. All of this is a further headwind for what we're seeing in private credit. And again, in the headlines, we talked about another pain point for private credit, another reminder that this sector is being hit not just by the higher rates environment, but obviously the further disruption in the software space. And we had the details around Ares Management posting the steepest monthly loss in one of its private credit funds on record in February. We're talking about 0.6, 0.7%. Doesn't sound a lot, but in terms of the historical context and everything else that's happening in private credit, it is another reminder that we are far from the end of this story.
Yeah, scores on the doors in those results. You have the likes of Blackstone and Apollo saying that this is all getting blown out of proportion. The concerns about private credit just doesn't reflect what's happening on the ground. They've been at that same symposium happening in Melbourne, and they say that the redemptions that we've seen, including from Ares, may reflect a lack of understanding on the part of retail investors. But interesting, we had a conversation with Lloyd Blankfein yesterday, of course, ex-Goldman CEO, speaking to Francine Lacroix on Bloomberg TV, saying that a reckoning is coming. It's easier to say that when you're out of the banking space, right? And he's saying that there's this accumulation of unsold private assets on investors' balance sheets. At some stage, that's got to come out somewhere, because it's a warning that some may be overvalued and could trigger this widespread markdown.
The counter to that is the original canary in the coal mine around private credit, and that's Blue Owl Capital. Mm-hmm. And what they're saying, the co-CEO and the chairman of that company, is that we are not seeing defaults in our portfolio. So that is the counter. He's been speaking in Australia as well, Ostrova, saying that we are not seeing a pickup in defaults, an increase in defaults. So they are trying to message around this. The portfolio remains relatively resilient, and that's what you're hearing from other members, of course, in this private credit space. But the scrutiny and the limelight still, of course, on that sector. Now, let's get you up to speed on what else to be thinking out through this show then. We're going to be speaking to Carl Tannenbaum, Northern Trust Chief Economist. Really important voice and analysis in terms of how to think about this inflationary environment and increasingly the impact on global growth as a result of this conflict in the Middle East. Paul Jackson, Invesco global market strategist at EMEA, still constructive on equities if we get a resolution in the short term when it comes to this conflict. And Anna Rosenberg, Amundi's geopolitics head, on different time frames and whether or not this is a moment where President Trump, as she says, either has to go big or go home.
Well, let's take a look at what else we're watching throughout the day. We have G7 foreign ministers meeting in France. Talks to centre, of course, on the Middle East, but also on the Ukraine conflict too. We've got EU Foreign Affairs Council meeting as well, and we have the OECD interim economic outlook. At 12:30 p.m. London time, we get US jobless claims expected to have ticked up from 205 to 210k, so still below levels from a year ago. And then we've got a load of Fed speaks. We'll be hearing from Lisa Cook, Stephen Myron, Philip Jefferson and Michael Barr as well.
OK, here's what else you need to know this Thursday morning. The US agency overseeing airport security says operations are under severe strain from critical staffing shortages. Travellers are now facing the longest wait times on record, with some stuck in queues for almost 5 hours. A partial government shutdown has left the TSA without funding for about 40 days and remains deadlocked over disputes on immigration policy. Shares of computer memory and storage products slumped on concerns over demand after Google researchers touted a new compression technique. The Alphabet unit said its new TurboQuant technology can limit the amount of memory required to run large language models by at least a factor of 6, reducing the overall cost of training AI. Memory forms a vital part of NVIDIA's accelerators, and demand has surged during the AI boom. Meta and Google say they will appeal against a California court decision holding them liable for a young woman's mental health struggles. A jury ordered the tech giants to pay $6 million to the woman after a landmark case centered on social media addiction. The decision highlights the potential multi-billion-dollar exposure of social platforms facing thousands of similar lawsuits. Deeply consequential. $6 million is hardly going to touch the sides for either Meta or Alphabet. The significance of this, of course, is that it opens potentially the floodgates to further scrutiny, further action, potentially further court action, potentially further legal action. And what was really interesting about this case was it was focused not on the content,
yes, but
on the design of these systems.
And we've got a great story on the terminal saying that this could put big tech, social media companies in the realm of big tobacco and opioid makers, because this is about addiction. It's not, as you say, just about the content. It's about how addictive the algorithm can be. And if there's more regulation as a result of the momentum that could result from a case like this, it would mean that perhaps users spend less time on social media apps, and the less time people spend, the less profit these companies
if they ultimately have to redesign the systems underpinning the likes of YouTube and Instagram in terms of recommendations, in terms of feeding content, the algorithms that power those systems, then that potentially, to your point, could reduce ad revenues for these companies. So that is another additional risk on top of the legal risk.
It's interesting that Apple's rolled out age verification requirements in the UK to users under 18. That's not where we're at yet in the US, because lobbyists there are claiming that it violates privacy. So let's see whether this moves across the pond, but there is a regulatory push against it happening here in the UK. Well, coming up, former Goldman Sachs CEO Lloyd Blankfein's been warning, as we say, that some private credit balance sheets may be overvalued and a spark could trigger a widespread markdown. We'll bring you some of that interview later on in the show. Plus, G7 foreign ministers gather in France today with the Iran war looming large over the meeting. We'll discuss what's on the agenda. But up next, we'll be joined by Andy Haldane, President of the British Chambers of Commerce and former Chief Economist at the Bank of England. So if you've got any questions of your own for our guests, please do send them to us on IB plus BBTV Go. Good morning from London. This is Bloomberg.
We settled 8 wars, people sort of forget. And we're winning another one, I tell you. We're winning so big, nobody's ever seen anything like we're doing in the Middle East with Iran. And they are negotiating, by the way, and they want to make a deal so badly, but they're afraid to say it because they figure they'll be killed by their own people. They're also afraid they'll be killed by us.
President Trump speaking there at the National Republican Congressional Committee's dinner in Washington, D.C., insisting that Iran is negotiating and desperate to make a deal to end the war. That's even as Tehran publicly rejected Washington's outreach and issued conditions of its own. Let's bring in Bloomberg Horizons anchor Jumana Paschi in Dubai for the latest. So, Jumana, conflicting signals then from both the US and Iran about these potential talks. What is the latest on these diplomatic efforts and this 15-point plan?
Is a conflicting signal and conflicting narratives around exactly what's going on at the state of those negotiations. As far as we understand from the Iranian side, there has been no signing on to direct negotiations and even indirect negotiations. As of now, a meeting or a potential summit between the two sides has not been confirmed. There are plenty of reports earlier in the week suggesting that maybe Pakistan would be looking to host something along those lines, but that is not being confirmed neither by the White House nor by Iran. And the messaging from Iran that has come through over the last 24 hours is that they remain defiant and they are not in the mood to compromise. Very maximalist demands as set out by their press TV. They're saying that they would like reparations from the U.S. for the war. They would like assurances that the U.S. will never strike Iran again. And then also, and this is a new one and has emerged as a key talking point around the war, is they would like to retain sovereignty over the Strait of Hormuz, which of course is not acceptable to many Gulf regions and also any nation really around the world, that one country would have this much authority over such an important choke point when it comes to global energy flows. So you can see the two sides are still very, very far apart in terms of the diplomatic starting point. And at the same time, I think we also need to pay attention to what has been happening on the ground. It is still day 26 of the war, ongoing strikes, counter strikes. The IDF are signaling that they're not letting up in intensity on the strikes across Iran. Iran continuing to lash back at Gulf states overnight. More drones and missiles being intercepted in Saudi Arabia and Kuwait. Bahrain, sirens going off over here in the UAE as well. We had an interception a couple of hours ago. And then I will also just say that we need to pay attention to the arrival of these marine expeditionary units that the US are reportedly sending to the region. The first batch is expected to arrive in coming days, the second batch in a couple of weeks' time. And of course, that is just another potential for further escalation, depending on where these troops end up going and whether they actually follow through, as some reports have suggested, on a potential takeover of Karg Island, something which Iran have said would be a red line for them. So let's see what happens in the next few days. Also a reminder, the 5-day ultimatum that President Trump pushed back comes to an end tomorrow evening in the Middle East.
Jumana, appreciate the context. That's Jumana Basecci in Dubai. Well, the economic impact of this war is rippling around the world. UK businesses facing a sharp increase in energy costs as the war drives up wholesale gas and power prices, threatening investments and curbing profits. Joining us now is Andy Haldane, President of the British Chambers of Commerce. Andy, welcome to the programme.
Thank you, Lizzy.
It's the BCC's Driving International Trade Conference today, so I wonder how much of a headache the war in the Middle East has created for your members exporting internationally.
Huge and ongoing. I mean, it's not the only headache. Even before that, we had elevated costs of people, wages, rising taxes, and now ladled on top of that, of course, we have rising energy costs, and coming down the line, we will have rising cost of money as well. So in some ways, we have this combination of forces coming together at a time when we know, Lizzy, business confidence was fragile and just beginning to show some signs of life. The risk is that now gets snuffed out.
I mean, remember when it was the COVID pandemic, you were Bank of England chief economist, you warned that inflation could be hard to tame if that tiger was let out of the trap. Is it best that the Bank of England hikes sooner rather than later to curb the second round effects that we could see from inflation?
A couple of important differences this time compared with back then. One, at least thus far, the rise in energy costs, gas prices in particular, is nothing like as great as then. And secondly, and I think more importantly, Lizzy, then that was a time when we were emerging from COVID and demand pressures in the economy were resurgent. That is not the situation we find ourselves in now. So we do have cost push inflation, prospectively, but far less of the demand pull inflation. And that makes me think this time will be a much, much, much damped version of that, in inflation terms at least.
Andy, does that suggest then that markets pricing in 2, potentially 3 hikes from the Bank of England this year are getting over their skis?
Yes. I think we've seen that whipsaw looks overdone at current levels of energy prices, Tom. That's an important qualifier.
Yeah.
Oil at 150, different game. But for me, as long as inflation is peaking below, say, the 5% threshold, there's less chance of that becoming baked in to households and companies' inflation and price expectations, and therefore less chance of those second round effects, which would require a more precipitate rise in rates rather than the flat that I think is more likely.
Oil at 150 and above could lead to those second round effects and could justify 2 to 3 hikes.
That for me is then the game changer. The point at which I think, there's no magic threshold for inflation, but I think as soon as you're north of 4 or 5%, that's the point households and companies start to rethink their views of the world. That was a situation back in 22-23 when inflation was north of 10% in the UK. That's what required the bank to play catch-up for the greater part of 18 months. We are not in that territory yet. And among the reasons I think we're less likely to reach that territory, Tom, is because demand and growth is soggier now than was then.
Yeah, I mean, we've already seen UK household confidence overnight plunging to the lowest under the Prime Minister, Keir Starmer.
Yeah.
On the fiscal side, how much help should the government be giving to businesses dealing with higher oil prices and to households as well with this higher cost of living when you've got such limited fiscal space?
Yeah, and that fiscal space has tightened up further. I think the UK is now in a position of some fiscal precarity. You see that very clearly in the constellation of bond yields right now, with 10 years touching 5% earlier in the week. The noises made by the Chancellor so far and the government, I think, are directionally right. This will not be the blockbuster all-in repeat of last time around Ukraine-Russia, more targeted. But I think the government will have to tread ever so carefully in what it does to extend the net this time round. The room for manoeuvre is very slight. The UK is very plainly in the sights of markets from a public debt perspective. And for me, the scope for misstep here speaks to a degree of caution and prudence in how that net is extended. Much as the political pressures will mount, now is not the time for bravery.
Now is not the time to rip up those fiscal rules then for the Chancellor?
I think the rules themselves and the framework is somewhat silly, but now is not the time to shred it, given the way that markets are.
You mentioned in your first answer, you outlined the number of headwinds for British business right now, and one of them was tax. Are your members starting to brace for additional tax hikes from this government?
Well, not yet. At present, their focus on the tax rises still to come that have been announced. But I think if the narrative were to change to think about, look, the headroom is gone, if there really is no scope to cut public spending, then the only way you reconcile the picture is through further tax rises. That is not the narrative yet. I hope it is not. I think as a nation, the UK is probably taxed out right now.
And when you're speaking to members, are they saying that they're likely to have lower profits because of all of these supply chain disruptions, tighter financial conditions, tax backdrop as well, and the energy costs?
Yes. Tax, energy, cost of money, cost of people. That's a far from divine coming together of factors, and that will show up either in squeezed margins, most likely, but also in upward pricing pressures. And all we see from surveys, including this week's PMIs, is that companies are certainly bracing themselves for a pretty lofty push-up in prices with all the inflation consequences.
We're reminded again, sitting in the UK, and I was in the US up until yesterday, and the difference in terms of our vulnerability to energy as a major importer versus the US, a major importer of food versus the US. Do we need China has built a domestic resilience plan. Do we in the UK need a domestic resilience plan?
We do for energy, we do for fiscal, and we do for economics. The short answer to that is yes. Does that mean on the external side, though, Tom, that we rein in our horns? No. The subject of today's trade conference that Lizzy mentioned is about now is a time to deepen trade. Why? Because it's the fastest and most surefire way of getting growth going. But two, crucially, to diversify our trading patterns, to cushion the shocks we're seeing just right now. Right now, the UK is a leveraged bet on the global economy. It's a high beta stock.
Yeah.
We need to lower the beta and lower the leverage nationally if we are to prevent a repeat performance.
Andy, really valuable insights. Thank you for joining us on a busy day for you and the team. Of course, Andy Haldane, President of British Chambers of Commerce and, of course, formerly Chief Economist at the Bank of England with that experience and perspective. Lines crossing right now in terms of Germany. Germany drafting plans to hit the US tech and drug supply companies. This as Germany is bracing potentially for a deepening of the disputes with the Trump White House. Germany is preparing for future disputes with the Trump White House. That line crossing. We'll get more context for you through the show.
Well, coming up, as European countries trim their growth forecasts, we'll dig into the repercussions of the Iran war with Northern Trust's Carl Tannenbaum. That conversation next. This is Bloomberg.
Welcome back. 30 minutes from the start of the opening trade this Thursday. European futures pointing lower by 0.9% after a solid session yesterday. Today, the mood is different. European futures then off by 48 points. FTSE 100 futures here in the UK lower by 28 points, 0.3% lower. CAC current futures over in France pointing lower by 0.8%.
Well, of course, it comes back to the geopolitics. We've got oil higher today, Brent at $104 a barrel, and you can see the risk-off mood reflected on the bond space as well. Yields higher across the European curve, stateside as well. The German 10-year now up 4 basis points at 3%.
we are risk off across these markets. The war in Iran then has driven up oil and gas prices. We're seeing that again today. Oil higher by a little over 2%. And spurring speculation, of course, of rate hikes from central banks globally. Bloomberg understands that the Italian government, meanwhile, is set to cut its economic growth forecast, while the Bank of France reduced its growth forecast and lifted its inflation prediction. Joining us now is Carl Tannenbaum, Chief Economist at Northern Trust. Carl, thank you for joining us in the studio this Thursday morning with your views. Where do you stand? How have you reassessed your outlook for this global economy on the back of this conflict?
Well, we've been reading that the president might be seeking an off-ramp. The problem is that once you get off the expressway, you don't want to get back on. Right now, the journey to safe harbor seems impossibly long. The two sides are asking for a lot, almost complete capitulation, so it could be quite some time before we see both the situation and the markets settle on the back of what's happened.
Your inflation outlook, are you starting to think about what assessments are you making? Where does that you're bracing for a longer term conflict, at least not a 4 to 6 week conflict, it seems. What kind of assumptions are you making about oil prices and the inflationary impact, as we hear that the White House is modelling potentially $200 a barrel?
So the central case that we've plugged in is 100 to 110, but that assumes that we gradually see the hostilities die down over these coming weeks. Certainly the scenario that's much higher is one that we've looked at, and it isn't very pleasant. It could certainly cause a global recession. I'd also note that this isn't just about crude oil. No. It's also about the natural gas on which so many Asian economies are reliant. Their production processes use it, and so we could see higher prices for things like microchips that are manufactured in Asia. And then the food story is also worth watching. We've all been going back to chemistry class to understand that fertilizer is a byproduct of refining petroleum. And without the fertilizer, the growing season is going to start off with a lot of uncertainty.
So what's the oil level that you think would trigger a recession? Because Larry Fink at BlackRock says $150 a barrel.
Yeah, and that's so hard to pinpoint. We've done a marvelous job over the course of the last 30 years reducing what we refer to as the energy intensity of GDP. We're a service economy both here in Britain and the United States, and so it's not as if we need this for manufacturing processes. But if you think of the role that power has been playing in the AI boom, for example, if that becomes more expensive, it's certainly going to take the edge off. Different countries will be affected in different ways. I think for a global recession, you would need something north of $150 per barrel.
Okay. And then in terms of the central bank response, I'm interested that you see the BOE on hold for a while. Is that because you think that the growth backdrop's too weak to hike, or is it because you aren't as concerned about the second round effects of inflation this time, perhaps compared to after the invasion of Ukraine by Russia?
Yeah, I think the challenge for all of the central banks that met last week was trying to peer through the fog of war to the fundamentals. Also the question of if you have a supply shock that drives inflation higher, do you look through that? For the Bank of England also, they met in a context where the economy was showing some signs of weakness with unemployment rising and long-term prospects certainly quite uncertain. So I think as they balance the two, they'll probably prefer, rates are still quite restrictive here in the United Kingdom, they'll probably choose to stay pat.
To what extent is the US an outlier, given it doesn't have that energy independence, given that growth is supported by a lot of AI investment as well? Growth projections have been coming lower for the US. Inflation has ticked up a little bit. We're seeing petrol prices and prices at the pump increasing. But it's such an outlier, it seems, compared to the rest of the world in terms of its dependencies and its vulnerability. Is there resilience there to the US economy? Are we underestimating how resilient the US economy can be to this conflict?
Well, during the visit, the United States has been described to me as an outlier for a lot of different reasons. But economically, in the near term, we do have the tailwinds of the ongoing tech investment boom, which has been very powerful. We have wealth effects that have come off the back of our equity markets that are boosting spending. And the tax bill that was passed last year is resulting in very large refunds, which are going to buoy consumer spending, taking a little bit of the edge off of higher gasoline prices.
And is part of the reason why you're only expecting the Fed to delay cuts rather than hike because of the change at the top? If we get Kevin Walsh, does the reaction function of the Fed change?
Yeah, I wouldn't say so. In fact, having worked a bit with Kevin, I think he's going to provide a certain level of continuity. He is quite serious about inflation. He does believe in the independence of the central bank. He has different views about how central banks should use their balance sheet, but those changes may be long in coming. Let's remember that he's got to convince several other folks on the governing council to go along with him before there will be any material change. I think as the economic fundamentals evolve, the Fed will find a way to get closer to the central of its neutral range.
Are you comfortable with the pricing that we're seeing through the US Treasury curve at this point? Is it reflective of the fundamentals and of the uncertainty that we're seeing?
I think it's fairly priced. When the 10-year U.S. Treasury yield fell below 4%, I was really wondering why it was there. And I understood that there were flows that were coming in for safety, but we have a very, very large budget deficit and debt. And so investors prior to that had been asking for a much higher term premium to invest in the U.S. As we drift back up to 430 and 440, that seems closer to fair value for me.
You see further selling potentially at the long end as a result of those deficit challenges?
So I think a lot will depend on what happens elsewhere, because a lot of the flows that buoy our treasuries come in from overseas. And so if you tell me that foreign markets will stabilize a little bit, capital will leave, our rates will go up.
And what about the ECB? Because I was listening to, I'm sure we were all listening to Christine Lagarde yesterday at the ECB and its Watchers Conference. She sounded pretty neutral to me. Is the ECB really going to hike?
I wouldn't think so. I understand that in the short term they're going to see rises in inflation. Their vulnerability to liquefied natural gas is very, very large. But I think she's also aware that the stability of growth in the euro area is not where she would like it to be, and raising into that environment probably wouldn't be the best thing.
But if they wait, may the ECB have to move in bigger steps, surely?
Potentially. All central banks are watching inflation expectations, which in the very short term have gone up by a lot, but in the 3 to 5 year range that they watch most closely, they've remained reasonably stable. If those lose their anchor, then the way to tightening is clear.
I just want to take it back to the top scenario and your view that 150 and above, we could be in a recessionary environment for this global economy. One scenario clearly being weighed up by the Trump administration is boots on the ground in Iran. And that clearly changes the dynamics pretty fundamentally. If that's something that happens over the weekend or in the days ahead, then we're looking potentially at 150. I mean, we don't know how that plays out.
Yeah.
So would you rip up the playbook on that? How would you start to kind of model that scenario for the economy?
For now, the deployment of the paratroopers is just to get them into position as a lever as the discussions continue. If the action is taken on Karg Island, the main oil terminal for Iran, that would clearly escalate not only the tensions but also the market reaction, because damage to energy infrastructure so far has been modest. If it gets larger, that's what gives you the very expensive oil scenario that we'd all like to avoid.
But what if you get other Gulf states getting involved as well? You could have the US troops on the ground being active, and then very quickly this could become a much larger war.
I think that's a real risk. The Gulf states, mind you, are already very involved, calling the White House to express their wish that this be prosecuted to the end, because Iran obviously has been menacing its neighbors for quite some time. But the cost of doing that economically and militarily would be significant.
Iran is looking to pass a bill to put, it's remarkable that the Iranian parliament is still apparently functioning at this point, but it seems they are, a bill to put fees in place, and they've already started charging those for some vessels crossing the Straits of Hormuz. If we get to a permanency around that, fees on vessels crossing the Straits of Hormuz, and they've been charging so far $1 to $2 million per ship, is that another inflationary dynamic that we would have to start to factor in if that becomes a permanence?
It would, but what would you rather have? Oil flowing with a higher fee, or oil not flowing at all and the uncertainty surrounding it? So if the fee schedule is one that we can live with and that it allows the traffic to get back to normal, I'd be in favor of it.
Well, you kind of wonder if it prolongs limited flows, if Iran can continue the war with its own control of the Strait of Hormuz and these $2 million fees. Isn't that worse than a full reopening?
Agreed. So if the off-ramp is taken too soon, Iran actually ends up in a position of power.
Okay, Carl, good to see you. Thank you very much for your analysis this morning. That's Carl Tannenbaum, Chief Economist at Northern Trust. Well, the former Goldman Sachs CEO Lloyd Blankfein says that the accumulation of unsold private assets on investors' balance sheets is a warning that some may be overvalued. He also told us that the US economy is well positioned to deal with any problems.
One thing when you compare crises and going back, we're in one that's unresolved, so it could get worse. And by the way, this is the one we're in. So it's worse and it's scarier in terms of our attitude and our minds. But if we went back to the same place at the same time at the global financial crisis, that was much worse. But it's hard to be scared of something that's resolved on the shelf in a can, can't hurt you anymore, it's not going to get worse, you're just reading about it. And so we're living with something that you are not just marking yourself to market and how bad is it today, but we automatically extrapolate to where it could go. So we'll get through this also. Look, I joked, I said, that we had the crisis of the century every 4 or 5 years. Whether it was the long-term capital, the dot-com bubble, the Asian currency crisis. We haven't had one in a long time. By the way, that itself is a reason for concern. Because if you haven't had a crisis, it means you haven't had a reckoning. You haven't had a sell in distress, things that have accumulated on your balance sheet that might not be marked correctly. And the more time, the analogy I like to give is you accumulate tinder on the floor of the forest, and eventually a spark will come. But the longer between intervals where there's a spark that sets it on fire, the more that accumulates. We're coming off a period where we had the highest equity markets we've ever had and a very, very favorable financing market. Yet a lot of private equity firms have accumulated a lot of inventory of deals that they've gone into, been on their balance sheet. They're highly incented to sell them, but they haven't been sold. If they haven't been sold in a good equity environment, in a good financing environment, how easy it's going to be to sell them. And so why not? Maybe they're marked higher than what you could get in the market. So at some point, there needs to be a forcing function or a reckoning that causes you to come to grips with what your balance sheet really is worth.
Former Goldman Sachs CEO, of course, Lloyd Blankfein, speaking with Bloomberg's Francine Lacqua. Coming up, Hapag-Lloyd warning of an earnings slump as the war in the Middle East causes considerable network disruptions. More on that next. This is Bloomberg.
We have a very sophisticated strategy, and when you go through shock periods like that, called hunker down. Like, I think for the time being, you got to be a bit more conservative around what you're doing in both interest rates, beta risk, equity risk, some of the credit risk. So, we've taken some of our risks down during this period, and I will tell you one thing I'm looking forward to is I think people underestimate. I think interest rates, you got a period where we're going to back up rates, and people talk about Fed's going to have to hike. I don't think the Fed's going to hike. In fact, I think they're going to cut rates. But you have places like the ECB, Bank of England, that are probably going to raise rates, depending on how the growth transmission happens. So I'm looking forward to, quite frankly, I don't think I'm alone in this. I'm looking for an opportunity, like when we think we're on the other side of this, buying interest rates, particularly front-end interest rates, that I'm super excited about. And I think the equity market is going to have people don't realize how much cash is sitting on the sidelines. You see it today, particularly in the equity market. Like, why is it some days the news is terrible, and then by the end of the day, the market grinds up? We, I think, like others, have built a lot of cash in our portfolios, so we're looking, to try and work your way through, what is a stressed period. But boy, I'm looking forward to getting on the other side. And, quite frankly, markets have been pretty composed. Yeah, and like some of the spread markets, they haven't really backed up that much. So anyway, you will see what happens over the next couple of weeks, and then I want to jump in and buy some stuff.
Well, that was Rick Reider, BlackRock's global fixed income CIO, speaking to Bloomberg, of course. Joining us now on the opening trade is our Markets Live executive editor, Mark Cudmore. Mark, there we go. We've got two sides. At least someone seems to be looking for an off-ramp, depending on the noises and the signal that we interpret. So brace ourselves. There could be a buying opportunity here, Mark.
I actually think how Rick Reider's outlined it there is spot on, but I think it's important to take it fully in context. I think that when we're on the other side of this conflict, it will likely be a great buying opportunity. We talked a month ago on this show about how we had an extraordinarily bullish macro environment for stocks. That was the setup for the last few months before the conflict. But the conflict is real, and we're not at the other side. And as you just said, Tom, only one side's really looking for an off-ramp. I don't know how the conflict's going to play out, but all the news flow would suggest that the base case assumption, unless you have some inside loop on the talks, is that there's going to be probably going to get worse before it gets better, which means I don't think we're at that buying opportunity yet because we have a lack of clarity. And in almost always in such scenarios, unless you're a very, very short-term trader, you're better off waiting till we know the problem's behind us and missing the first part of the bounce rather than trying to preempt it. You know, you go back to the GFC 2008, 2009. If you were trying to buy the whole way down in January, February, March 2009, you lost your career, you lost your job, you got stopped out. If you waited until May or June, you may have gone, oh no, I missed the first 10, 20, 30% of the bounce. Who cares? You had several hundreds % of upside in a one-way trade. And I think that's the way you've got to look at this. There is a lot of liquidity on the sidelines, as Rick Reader points out. When we get to the other side, if we get soon enough, it'll still be good. The problem is, what if we don't get to the other side of this conflict in the next month or two? Then the damage to growth is much more material. So I think how he's laid it out is right there, but I think it's important to emphasize not to preempt it.
Mark, as a mark of the risk aversion today, we've got gold down along with stock futures and Asian stocks already. What's your thinking on gold as a haven right now?
As you know, I think the gold, I turned bearish gold at the start of the month. As soon as we finish the invasion, that is an extremely bullish signal for dollar. So, you know, that on what happened at the start of the month, that's bad for gold. It's extremely inflationary. That means higher yields. That's bad for gold. And if people had bought gold because they're worried about a war in the Middle East, well, you just got your war in the Middle East, so you take profit in that trade. So as we've talked quite a bit, Lizzy, my view this month was to turn bearish gold at the start of the month, and I still think it's got more downside because the conflict is not over. And I don't think people will return to the bullish gold trade until those dynamics change. And until the conflict is over, we're going to continue to have strengthening dollar. We're going to continue to have a little bit of upward pressure in yields, at least for the moment, until we focus on the growth factor. And it's lost its kind of edge as a growth hedge. There's an extra dynamic as well. Central banks around the world, whether it's Poland or Turkey or others, are talking about potentially having to sell down their gold reserves they've accumulated to provide some kind of fiscal stimulus to their economies in various different ways, or to ameliorate the impact from energy. So, look, I still think gold's got a chunk more downside and won't turn positive until the conflict's over.
Okay, Mark Cudmore, Bloomberg Markets Live Executive Editor, thank you very much. And remember, you can get up-to-date analysis and insight from Mark and the team by going to MLIV Go on your terminal. Let's take a look now at our stocks to watch with Bloomberg's Louise Moon. Louise.
Good morning. The first key stock we're looking at today is the Italian bank Monte Paschi. Now, they've ousted their CEO. They've decided to remove him. That's the board, after he essentially challenged the board's plans to replace him. So he's been in the role since 2022. He's overseen a huge restructuring. He's brought the bank back to profitability, also oversaw a takeover last year of another major bank, Midio banker. But essentially now his plans to integrate that into Monte Paschi has kind of failed to impress shareholders. His interests don't align going forwards. As you see, since about 2022, he has increased the share price, slightly as he's returned the bank to profitability, but as those interests don't align, they've decided to remove him going forward. So we'll be watching that one at open. Another key one we're watching today is Hapag-Lloyd, the global shipping giant. Obviously, a key stock that's been in focus since events in the Middle East, and you can see the stock has been relatively volatile, but has risen about 17% since the war broke out in the Middle East. They have had their results, their full-year results. They're now expecting earnings next year to come in weaker than this year, and most of that is due to this disruption in the Middle East. They're saying that the conflict is causing considerable network disruptions and sharply increasing operational costs. They're expecting about 50 million added of costs per week. So per week, 50 million, and that's really going to weigh on their earnings. You'd expect that to potentially weigh on the share price at open. And finally, looking at apparel retailers, clothing retailers, mostly in the UK. Now, we've had fresh data from the British Retail Consortium saying that confidence for Brits has plunged to the lowest under Keir Starmer, expecting this to potentially weigh on the likes of Next, H&M, Frasers Group, already down over the past year. Next has also had their full-year results this morning, saying 15 million added costs from the Middle East. So we'll be watching that one closely at open.
OK. Louise Mead, thank you very much indeed on some of the stocks that could move in the session today. The consumer here in the UK under further pressure then and constraints potentially on retailers. We're going to focus a bit as well before we get to the break on what's happening in the semiconductor space. Some interesting news and movements, particularly in Asia. You've got the likes of SK Hynix, Samsung, the makers, of course, of memory chips, Lizzy. Normally we talk about the fact that these stocks are rallying. Today there's some downside pressure, and this is coming on the back of a report that Google, or an announcement in fact, that the team at Google have produced a system, basically a compressor, which means that you can train these large language models with a lot less memory. So that is suggesting, for some at least, that maybe the tightness in the high bandwidth memory or memory space may be being eased. If this becomes widely adopted, maybe you need less memory. Others are saying that, in fact, what's it going to do? It's going to accelerate adoption.
Yeah, the question being, is this a hiccup or an existential threat for competitors in this space? We'll look to see if there's any impact at the European Open. As you say, you've seen the likes of SK Hynix falling as much as 6.4% on the Kospi today. So perhaps we'll get a European read-through as well.
Yesterday, the session in Europe was pretty strong. Gains of over 1%. It's basic resources. Every single sector was in positive territory. Today, it's very different sentiment. You've talked about the fact that bonds are selling off. Futures are pointing lower as well. Broadly down 0.8%. There is risk aversion today on the confusion in terms of the signals we're getting from both Iran and the US.
Yeah, yesterday traders latching on to the idea that, well, just the fact that the US had this 15-point plan. Today, really latching on to the fact that Iran says, no thank you, and we want our own terms when it comes to ending this war, if this war is going to be ended. So futures, as you can see, pointing south as we head towards the opening trade in 5 minutes. This is Bloomberg.
OK, a few minutes to go then until the opening trade this Thursday. Let's look back at the session yesterday. This then is where the European market closed with gains of around 1.5%. Every single sector in positive territory yesterday across the European space. Basic resources at the top of the list. A lot of that was down to the news and the headlines. Again, this is a headline-driven market, and it was headlines about talks underway. At least that was the narrative from the US administration. You had then the S&P 500 closing up about 0.5% by the end of the close yesterday. Today, it is a different picture. Let's check in on the futures then, because the fog of war is very much here. Both sides signalling different narratives in terms of whether or not we are in talks, how far those talks have gone. Iran rejecting this 15-point plan, apparently being put forward by the US administration. So more caution in the session today on that uncertainty. Again, headline driven in an environment where, at least for some, equity markets are kind of hedging towards expectations that maybe you get an off-ramp. But big question marks about that is you see a build out of troops in that region. European futures currently pointing low by 0.8%. FTSE 100 futures pointing low by 37 points. DAX futures down by 1%. Lizzy.
In terms of some of the individual stocks we ought to be watching this morning, Tom, Monte Paschi is one of them. We have the news that its board has stripped the CEO from his powers. We also keep an eye on H&M, reporting a weak start to the year. Sales disappointing for that Swedish fast fashion retailer. They've been plagued by weak consumption and large currency effects as well. Finally, Hapag-Lloyd, of course, the German shipping company, really in the eye of the storm of this geopolitics, but expecting significantly lower earnings because of the war, disrupting trade flows and raising costs as well, Tom.
OK, retailers, shipping companies, of course, banking. That's a slightly idiosyncratic story. We'll look at all those sectors at the open. We are opening now this Thursday. Again, futures had been pointing low. The FTSE 100 is currently down 0.1%. You've got gold prices weaker in the session today. Interestingly, again, gold not playing that role in terms of a safe haven. Oil prices, Brent is up over 2%. WTI, the last time I checked, was also there. We crossed 105 on Brent. Currently, the FTSE 100 now down 0.5%, so slightly steeper losses coming through for the FTSE 100 across the benchmark. Stock 600 currently down 0.4%. We still wait for the pricing on the DAX over in Spain as well. The CAC Coronet in France had been called lower, and that's what you're seeing right now, down 0.6%. The Spanish IBEX off by 0.6 as well, and the sell-off getting a little deeper here in the UK with the FTSE 100 down 0.7%, and a reminder that the consumer is under pressure, retailers very much in focus, and expectations from these markets that maybe the Bank of England hikes as many as 2, possibly 3 times this year. Across the benchmark again, European stock 600 currently down 0.6%. If you lift the hood, what are you seeing on a sector-by-sector basis, Lizzy?
Well, Tom, you mentioned oil flirting with $105 a barrel on Brent once again, and that it mean it no surprise that you've got energy near the top of the basket. Just two sectors in positive territory this morning. That's energy and media, both up about 0.1%, but the rest of the basket reflecting that risk-off mood that futures had been pointing to. Basic resources today at the bottom, down 1.7%. Banks down 1%. Tech as well, selling off, down 1%. We talked about potential read across from that Google breakthrough. It had already hit some of the Asian tech names. And I had flagged that we should be watching Monte Paschi after the CEO was stripped of his powers. Those shares are down 1%. You've also got H&M shares down 4.3% after that weak start to the year. Their sales disappointing in their results. And we'll just keep an eye on Hapag-Lloyd. We're waiting for those to open still at the moment. Maersk is shut today, we should say, ex-dividend. So we won't be getting a reading of the shipping sector from them just yet.
So a complete reversal in terms of the gains that came through for basic resources. That was your top sector yesterday. Today, biggest losses coming through for that sector, down 2%. It's worth noting that silver is selling off. It's down 2.8% right now. Silver under pressure. Gold down 1.1%, as I mentioned as well. So that's part of the mix in terms of the negativity in basic resources. To your point, Lizzy, just two sectors and just by the skin of their teeth in positive territory. Media and energy. Interesting in terms of the breakdown then. You are seeing pressure on the miners. So Antofagasta, that's the silver story, down close to 4%. And to your point, the retailers with H&M down close to 4% as well. Let's zoom out and get a view right now with our guest in terms of the market analysis and bring in Paul Jackson, EMEA Global Market Strategist at Invesco. Paul, how do you trade the headlines at this point?
I think it's really difficult. I think that you have to stick with a sort of medium to long-term view, keep your strategic vision and don't get dragged into the short-term movements, because as we've seen from yesterday to today, it's just massive swings. So I would say stay happy, because happiness helps us to keep long-term horizons, and stick with those long-term horizons, stick to your guns, don't get dragged in.
You are not positioning for an off-ramp at this night. You are not positioning for a potential ceasefire. You're not positioning for a point where the two sides come to some kind of agreement, as unlikely or not that is.
Well, I would say that we were already positioned for a relatively optimistic outcome. And
remind us why what was underpinning that relatively optimistic outcome.
So before the conflict started, we were expecting the global economy to accelerate. Interest rates had been coming down for a couple of years. Money supply growth had picked up. There's a bit of a fiscal boost in Europe and Japan coming through. Real wages were rising. And you could see in leading indicators that around the world that they were improving and already above trend. So it looked as though we were set fair for economic acceleration, which is usually good for cyclical assets. And the question is, how long does this current conflict need to go on to totally upend that reasoning? And I think we've probably got a couple of months of energy restrictions and restrictions of flows through the Strait of Hormuz before this becomes a situation that we would have to totally revisit. So I would say that we at the moment are positioned more for an optimistic and a short, an outcome, a good off-ramp in the short term. That's the way that we are positioned. The risk for us, and in terms of our positioning, is that it goes on longer and you get energy prices that go even higher and stay higher for, say, 3, 6, 12 months.
I did wonder if you'd picked your shirt as a symbol of the dominoes falling, Paul. But if you're an investor, what's the best blueprint to be using as a historical parallel to this situation?
Well, I think the fear comes from looking at 1973, 1974. That clearly was a situation where the oil price quadrupled. Funnily enough, supply of oil only fell by 7% between 73 and 75. But the oil price quadrupled. We had big inflation, deep global recession. It was a disaster for most assets. And that's obviously in the back of the mind. But we're not getting those sorts of price gains. And the world is not as dependent on oil as it used to be. Even since 1990, the oil intensity of global GDP is half of what it was. And I suspect that since 1970, it's probably a third or a quarter of what it was. So even if you do get big oil price increases and you get a similar oil shock to what we had then, the effect on the global economy will not be as big because we've weaned ourselves off oil since then. It will be negative, but it won't be as big.
And what's the signal then that equities need to trigger a rebound? Because you can have all the progress in talks you like, but it doesn't mean that the Strait of Hormuz is going to be unrestricted completely. What would be that trigger?
Well, I think the first trigger is that there are actually talks.
Which we had yesterday.
We
had the start of...
No, we've had one side saying there are talks and the other side saying no, there are not. So we need firm evidence that both sides are at the table and are talking to each other rather than across each other. So that would be, I think, taken as a positive signal. Aside from that, a freer flow of shipping through the Strait of Hormuz, either in the way that Iran is allowing it at the moment, but an expanded volume, that would be good news. And we've also got something like 5 million barrels a day capacity from Saudi Arabia through the Red Sea rather than through the Strait of Hormuz. That is happening. More ships are heading in that direction. And so if there is a flow of oil coming from that direction, that could mitigate things as well. So I think those two things taken together, independently of the talks, could also give us good news. But at the end of the day, we want to see energy prices come down. And it's the downward movement of energy prices that is going to be critical, I think, for equities, for bonds, for pretty much every asset category.
Where are you, until and if we get a conclusion to this conflict, what are your favourite hedges? Where are you looking for insurance?
Oh boy, it's really difficult. The
Treasuries are not playing the role, bonds are not playing the role, gold's not playing that role.
Which you wouldn't expect treasuries and equities to play that role. If you're just concerned about inflation, if you look at the correlation with inflation in the US and US asset returns, there's really nowhere to hide if you look at the historical evidence. Commodities are really the only asset category that has that positive correlation, but I would argue that the correlation is in the wrong direction. It's because of rising commodity prices that you get the inflation rather than higher inflation pushing up commodity prices. But once again, this conflict, I think, has shown the value of commodities as a diversifier within a broad portfolio. If you look at the history of it, the correlation between broad commodity indices and other asset categories is slightly negative. That means it's a great diversifier. It's a volatile asset, but a great diversifier.
So commodities as a diversifier. What about a regional diversification strategy?
Regionally, I think, as we've seen already, the US assets have been relatively protected, not fully protected, but relatively protected. The dollar has strengthened. And I think that comes not so much from the idea of the dollar being a safe haven. I think it's more to do with just the economics of the situation, that the US is largely energy independent. Its balance of payments is perhaps benefited by rising energy prices. So the dollar is benefiting from that. The US economy is relatively shielded compared to especially Asia, but also compared to Europe. So I think if you do a ranking, US is most protected, Europe clearly not protected, but Asia is very vulnerable when you look at the amount of energy that comes from the Middle East.
Well, how much of the S&P's resilience is because there's still that optimism over earnings, and how much of that is because analysts are just reluctant to change their outlooks when you haven't got that hard economic data yet, because they're waiting for the geopolitics to translate?
I think there may be a bit of that. I think we had been shaken out of last year. Markets were shaken out of this idea that the US market and that mega cap US stocks will always outperform. And at the beginning of this year, that was continuing. Then this comes along, and I think that maybe it has caused a bit of a reversion to previous behaviors. But I think it is helped by this idea that the US economy is relatively sheltered, that there is some sort of protection by being in US assets. It's not total protection, but it is some sort of protection. And yes, no doubt it is encouraging once again the idea that, well, you see, US mega caps, US tech is always going to outperform, which was never true and will not be true in the future.
Okay, Paul. Paul Jackson, global market strategist over at Invesco. Thanks for coming to see us. Let's take a look at the core six, shall we? How they're faring up on this risk-off day. And surprise, surprise, it's only Nestle that's up by 0.4%, but everything else in the red. Novo Nordisk seeing pronounced losses of 2.7%. ASML also down 2.3%. Perhaps a read across from what we've been seeing from Google, that weighing on the tech space more broadly. Let's go to Louise Moon with some of the other individual stocks on the move today. We're more. Louise, over to you.
First up, Lizzie, we are looking at retail earnings. Now, we've had two major companies reporting this morning. Firstly, Next shares, as you can see, rising over 5%. Now, they did warn of more costs from the Middle East conflict, but Met estimates maintained guidance, even lifted guidance in some cases. Their CEO is known for kind of giving relatively conservative guidance and then lifting that later on. So investors welcoming that. H&M, however, declining over 5% after their own earnings. I think this was the steepest decline since around April. So really steep declines there for H&M. Next up, we're looking at Hapag-Lloyd, the German shipping giant. Shares slightly ticking just higher. Now, they have actually warned that next year earnings will come in weaker than this year. But, rising despite all those headwinds as the conflict in the Middle East continues. Now we're turning to Italy, down to Monte Paschi, the Italian bank. They've ousted their CEO after he didn't abide with, the board's plans. He challenged the board's plans to replace him. Shares falling into the red after that. He's overseen the bank returning to a rise in profitability, taking over Mediobanca, so investors dragging those shares down into the red after the news of the CEO leaving or being ousted. And finally, we're looking at chip stocks. So the likes of ST Micro, higher, slightly into the green. That's after an upgrade by Morgan Stanley, seeing those stocks as a more attractive pick at the moment. So ST Micro rising on the back of that.
OK, Bloomberg's Louise Moon, thank you very much indeed on some of the stocks on the move this Thursday. Another stock in focus is Currys, with change at the top there. Currys CEO Alex Baldock is stepping down after 8 years in charge of the retailer. He was also pretty consequential in helping to turn the company around after that merger. He's leaving Currys, then created in 2014, the company, of course, when it merged Dixon's with Carphone Warehouse. And he's leaving Currys to take a new undisclosed external position. And the stock, the last time I checked, was down on the back of that news, falling double digits at one point in early trading. The stock was up about 50% in the 12 months through Wednesday's close. So change at the top. That's Currys, Lizzie.
Yeah, just also looking at a load of private credit-linked stocks. Of course, we mentioned at the top of the show the disappointment for Ares with its numbers. We've already seen it capping the withdrawal requests following a number of others. But today, the likes of AXA, Allianz, Legal & General, NN Group, all in the red. But difficult to separate that out from the broader risk aversion that we're seeing in these markets on the geopolitics. Coming up, as I say, oil higher as the US and Iran offer conflicting comments on efforts to end the war that shuttered the Strait of Hormuz. We'll get a closer look at that next. This is Bloomberg.
Welcome back to the opening trade. We are 18 minutes into the Thursday session. Renewed uncertainty across the equity markets. The benchmark stock 600 currently down 0.7%. Just 5 sectors so far in positive territory. Personal care and products up just 0.2%, and that is the best performing sector. On the downside, the biggest losses coming through for basic resources, down more than 3%. As you can see, the DAX is lower by 1.1%. Here in the UK, FTSE 100 off by 69 points, down 0.7%. We're focused on retail as well, Lizzie.
Yeah, one of the sectors managing to to eke out gains this morning, Tom, but it's a mixed picture for two of those who've reported numbers this morning. Next is up 6.5%. H&M down 5.5%. This after H&M first quarter sales fell short of expectations in a period plagued by weak consumption. Next, meanwhile, maintained its guidance, but did warn that the war in the Middle East will add £15 million of costs to the UK retailer's profit guidance. For more, let's bring in Bloomberg opinion columnist Andrea Felsted. And I want to start with Next, Andrea. What do these earnings tell us about that high street retailer?
Well, Next has been doing pretty well. You know, it's really defied, the doom in UK retail. It benefited last year from Marks & Spencer's having IT problems. It's just a very well-run retailer. It knows who it is. It knows who its customers are. It's got a strong online arm. It's got a growing international business. So it's the best, probably the best run retailer in the UK.
What are they doing? What's Next doing that H&M that Hennies isn't doing?
Well, H&M, I sort of always struggle to figure out why they're not performing. Somebody described them to me as they're not fast and they're not fashion anymore. I think the other thing is, I think they're stuck in a bit of a Shein Zara sandwich. They're the filling in the middle. So you've got Shein,
appetizing.
Exactly. You've got Shein, really low price. You've got Zara going increasingly upmarket, filling that white space that's been left by the luxury brands. H&M are somewhere in the middle. So that could actually work in their favour, because the danger for Zara is it goes too upmarket and alienates some of those more value-conscious customers.
So Zara is upmarket now?
Zara has been really stretching. It's still got the opening price points, but it's been increasingly moving into a premium retail area, because all the luxury brands have gone so far. They've taken their prices up so high. You've got all this white space that's been filled by brands like Coach, Ralph Lauren, Cezanne. So Zara is sort of moving into that market, which is very smart. But the danger is that some of those shoppers that went there for really, cheap go somewhere else. And H&M, if it can get its act together, could pick up some of that trade.
So a lot of these idiosyncratic stories about how these businesses are run, is there anything that we can extract about the strength of the UK consumer? Because we had numbers this morning saying household confidence is at its lowest under Prime Minister Keir Starmer.
Well, I think the biggest issue is going to be what the war in Iran does to costs. I mean, Next said they've got 15 million of costs coming through, things like freight, energy. They can offset that. The problem is if it goes on a long time and we start seeing that really feed into petrol prices, household energy costs, then consumers they've got to spend more on the things they need, so they've got less left over for the things they want. Next said prices aren't going to go up sort of right now, but if this carries on, we're going to see it really hit in the autumn when the factories that make the clothes have to deal with their own energy prices, as well as energy that goes into things like polyester, oil that goes into polyester. That will come through, and they were talking about maybe 5% increase in the autumn. But the thing is, there's a little offsetting factor which also goes in Zara's favour. What they've noticed is their customers are buying fewer but more expensive products. So if they can, there's lots of things you can do when you face higher prices. You can make things. You can put less wool in a cardigan so it's a bit more itchy, or you can go the other way and you can sort of add piping to a collar, put a fancy lining in, add some trimmings, which helps you to charge more to customers because they think it's better quality. So if people are willing to spend more on clothes but buy fewer items, then that does help you with the costs coming down the line.
Piping and itchy cardigans.
Yeah, I always knew that.
Lizzy's not going down that route.
I always knew that dressmaking O-level had come in handy one day.
I led into that. Bloomberg Opinions, Andrea Felsted. Andrea, thank you very much indeed on this retail space. Let's get back. We were talking about the inflation impacts there on retail. Let's get back to the oil price story right now, because you are seeing Brent and WTI both higher in terms of the session inputs that we're seeing. Up 3% right now, 105 on Brent, $93 a barrel on WTI. Let's bring in Anthony DiPaolo then, Bloomberg's Middle East energy market markets report. Anthony, just give us an update in terms of what's happening across these energy markets. On a day when we have a Turkish tanker apparently struck in the Black Sea, what is the momentum behind higher prices today? Is it the continued uncertainty around the conversations between Iran and the US? What are the catalysts? We're above 105 on Brent.
Good morning, Tom and Lizzy. Yeah, that Turkish tanker, as you mentioned, that just kind of reminds us that there are still ongoing conflicts elsewhere as well, too, as we've been so consumed by following the Middle East crisis. I think this one is clearly the bigger one for oil markets at the moment, because we still have the Strait of Hormuz largely blocked and so much oil stuck inside the Persian Gulf, unable to get out. We've seen oil, as you said, come up. We're at about 105 for Brent, and we've really had the last couple of days down back around $100 a barrel. So quite a moderate price given the situation where we are in terms of markets being starved of oil, chemical makers starved of feedstock, nothing getting out of the Persian Gulf, and that's been the reaction really to this kind of jawboning war that's been going on with the U.S. administration making comments that are really seem to be aimed at talking the oil price down as well. That's not to take away from the fact of negotiations around some sort of peace talks or some sort of ceasefire. Of course, the Iranians have denied they're in talks with the United States, but at the same time come out with their own demands for talks. So that does indicate that the two parties are staking out their positions. At the moment, kind of looking like a maximalist positions at the moment. So if negotiations go as negotiations normally do, perhaps you find some way somewhere in the middle. Of course, we did see the Iranians saying they want access and control over the Gulf and ability to control who goes through there and to charge fees for that. That's got to be a non-starter for a lot of the Gulf allies, because that's the issue that's got us into this problem in the first place. The fact that there's not that free transit through the Gulf, the oil and refined products are not able to get to markets. So we've seen those fields shut in. We've seen refineries closed, damage created, and that's going to take longer for those companies to get back up and running. The longer it takes, the longer this closure takes, it will be more difficult for them to get back up and running and back into the market, Tom.
OK, so a non-starter for Gulf nations. Thank you, Anthony, very much. That's Bloomberg's Anthony de Paula out of Dubai. Well, you mentioned the oil price. Brent is higher, of course, today, but also keeping an eye on the miners as we're looking at gold weaker, silver weaker, copper weaker too. And there we have on the screen, as you would expect, Fresnillo down 4.2%, Antofagasta about the same, and Anglo-American suffering too, Tom.
OK, coming up, as the US and Iran wrangle over those talks then, we're going to discuss the geopolitical implications of the ongoing war with Anna Rosenberg of the Amundi Investment Institute. What would US boots on the ground mean for this conflict as well? Another question. That is next. This is Bloomberg. Welcome back. This is the opening trade. We are 30 minutes into today's session, reversing most but not all of the gains of yesterday, currently down 0.9%. But certainly there is more caution in these markets on what is happening in terms of Iran. Very headline driven still in terms of trading around equities. The biggest losses coming through for the DAX, currently down 1.3%. As you can see, the CAC 40 over in France dropping 58 points. And here in the UK, the FTSE 100 down 85 points, down 0.8%. Lift the hood, and what do we see, Lizzy?
Well, as a mark of the risk aversion that you've just outlined in markets, Tom, we've got 459 members of the Stock 600 lower compared to only 121 up this morning, and also as a mark of the volatility and traders wanting to stay away, perhaps, volumes down nearly 40% at this point. Flip over and we can look at some of the leaders. out today. Shell up 0.6%, up with oil prices higher on the back of those Middle East tensions and the fragile talks as well. Next, we were just discussing with Andrea Felsted, rising despite saying that the Middle East conflict will add around $20 million in costs because sales met estimates and it maintained its guidance. And then we turn to SSAB, up 3% this morning after it was raised to buy by ABG. But let's take a look at the laggards. ASML, one of the biggest in fact this morning, down 3.1%. Shares of memory and storage companies sinking after Google researchers touted this new compression technique for LLMs and vector search engines. We'd seen some of the Asian tech names suffering as well. On the flip side of the retail story, H&M down 5.6%. First quarter sales falling short of expectations because of weak consumption and big currency effects for them. And finally, Boliden down nearly 20% here after RBC reported that the impact on one of its mines that it had halted production at earlier in the year or earlier is worse than expected, Tom.
OK, here's what else you need to know. This Thursday morning, then, the former Goldman Sachs CEO, Lloyd Blankfein, says the accumulation of unsold private assets on investors' balance sheets is a warning that some may be overvalued and a spark may trigger a widespread markdown. The former Wall Street chief, who spent much of his career as a trader before leading Goldman during the financial crisis, made his comments as the AI disruption caused by the AI story and pockets of alleged fraud have caused jitters in private markets. Meta and Google say they will appeal against a California court decision after they were found liable in the first ever social media addiction trial. A jury ordered the tech giants to pay $6 million to a 20-year-old woman who said her addiction to social media caused her mental health struggles. The ruling highlights the potential multi-billion-dollar exposure of social platforms facing thousands of similar lawsuits. And US President Donald Trump is insisting that Iran is negotiating and desperate to make a deal to end the war. That's even as Tehran publicly rejected Washington's outreach and issued its own guarantees, including that the US and Israel won't resume attacks, reparations for war damages and recognition of its authority over the Strait of Hormuz. Meanwhile, Iranian media reports Iran is drafting a law to impose Hormuz transit tolls.
Well, let's get some analysis on the geopolitical situation now. We're joined by Anna Rosenberg, head of geopolitics at the Amundi Investment Institute. Welcome back, Anna. You've described this as a go big or go home moment for President Trump. So now that the ball's back in the US's court, Iran having rejected this US proposal, what is President Trump's next move?
Well, I think we have to be very clear that this negotiations is mainly a show. It's not about substance, because they're both far removed from agreeing on any of these terms. Israel too. So this is very much about, are both sides willing to show that they are kind of willing to step back from the brink? And I think it's in both sides' interest to do so, in Iran's interest and in the US's interest to take a step back. But ultimately, we shouldn't underestimate what's at stake here for the US, because this is not just about the very short term. This is about big geopolitical changes. And Trump really is facing a moment of monumental historical importance. It's about, do I go big and do I try and seize control of the Strait of Hormuz? And do I try to decimate the threat from the Iranian regime for the Strait of Hormuz, but also for the region, for the Gulf countries, for the Red Sea? Or do I leave it at that? And essentially, then I will have lost the war, because Iran will remain in charge. And that will undermine the US position on the global stage.
And if the US does go home, then how would Israel react? How would that leave the relationship with Israel?
So Israel is probably going to be okay. Our base case for this conflict has always been that this was going to be a hot phase of aerial bombardment, US and Israeli strikes. It comes to a close after a few weeks, and then we move into a phase 2. Because this is not going to be over. This is an opportunity for Israel and also for opposition forces within Iran to continue to weaken the Iranian regime. They're not going to just sit idle now. Something's going to continue. So we're likely going to move to a lower intensity war that will mean that Iran will continue to disrupt the region with occasional drones, with disruption of the Strait of Hormuz. That means we're not going to go back to a time where the strait was fully open. So I think we have to assume the base case is ongoing disruption. And Israel will continue to aid opposition forces, protesters, to continue to destabilize the regime. And so if Trump decides to go home now, they're probably going to say, okay, fine, we had our thing, we did this big, they were on our side, we can't ask for more, but they're going to continue to disrupt. So the base case is don't assume a full ceasefire that means we're going back to the status quo ante. I don't think that's very likely.
It seems to me that the risk for the markets is that they assume that your base case comes to pass, which is that President Trump ultimately walks away from this conflict, declares victory, and we can assess whether or not that is valid or not. But you get that disruption. The markets then pounce on that. They lean in, there's cash on the sidelines, equities rally, oil comes down. But maybe they underestimate your point, which is that continued disruption is there. And that has an effect for the economy, that has an effect for inflation. That, for me, seems to be a potential risk for these markets.
Yeah, absolutely. That is the biggest risk that we have out there. And we are in a new world with drone warfare. Drone warfare is a new thing in this environment. We haven't had that before. It means that you actually essentially can wage wars forever. The only solution is not on the battlefield, it's diplomatically. And diplomatically here, it's incredibly tricky because you now had a regime that is even more radicalized, that has realized that its only deterrence is to cause global economic chaos. So to really have a diplomatic solution is very, very difficult in this context. So drone disruptions, drones are cheap, they're easy to produce, they're difficult to track down. I think we have to assume that disruption will continue for a while.
Can I put another scenario on the table? And that's one that could be deployed, which is boots on the ground. And we're seeing a build-up, 5,000 troops plus 1,000 82nd Airborne are the reports. So it seems like in terms of optionality for President Trump, this is real in terms of giving him this option. Have you mapped out, can we map out potential second and third order effects of having US boots on the ground, whether in Karg Island or on the coastline next to the Straits of Hormuz?
Yes, of course. So firstly, I think this is a decision that Trump has to make now. And I think the stakes are very high. I think the risks are high that he decides to go big because, as I said, this is about a historic moment. This is not just about the short term. Assume he controls the Strait of Hormuz, it would allow him to say, I control global oil flows. It would have reestablished deterrence of the US in the eyes of the world. It will have pushed back China's influence too. And for the Gulf countries, and this is very important, this is existential because the business model doesn't work if there's ongoing war. Because the Gulf countries are hostage of their geography, and the geography remains volatile. So if Trump decides to go big, then you're going to have a situation which is going to be very messy, and I think going to take quite some time. He will probably focus first on the islands before going into Karg, the region. But keep in mind, this is a country of 90 million people with a very strong and big armed military apparatus. So I think this will be an intense, if it happens, it would be not an easy thing. It would take time and it would likely cause quite a lot of disruption. But our base case is that he goes home and not goes big because he's constrained by domestic politics. He's facing a midterm election. And so that's the base case.
And you talk about the importance of diplomacy. Who do you expect it is that the US is talking to in Tehran? They say, we're not talking to the US, but with so much of the leadership killed,
yes.
Who is that going to be?
Well, there are interlocutors, there always are. We currently have Pakistan, which is interesting because they're fairly new to this negotiating table here as an intermediate. We've had Oman usually in the past. On the Iranian side, there are lower tiers, representatives. I don't know who specifically it would be right now. There are some indications, but who knows? Ultimately, it's always been Tehran's policy to dismiss that talks are ongoing. If there is a ceasefire now, or if there's a deal, which I think could look something like the US says we're going to stop hitting bombs at you, and then Tehran says, okay, and we're going to open the Strait of Hormuz. That's the extent of the deal we're going to get. It's not going to be more detailed than this.
Yeah.
So if this happens, then both have to look like victors.
Well, I wanted to ask, where Tehran's come back with its own plan of what it wants, do you see that as a starting point, or are they red lines?
No, I think this is a starting point because both have an interest in de-escalating. Trump for domestic political reasons, and Tehran simply because they need to survive and they know that this could get bigger and they could lose Karg Island. So ultimately their interest is let's stop this and let's focus on what we're best at, which is lying low and rearm. That's what their incentive is going to be. So the question is, how do we go from this current show of negotiations to a point where both agree they can look like victors? and things calm a little bit and we move to phase 2 of this conflict.
I want to bring a slightly different angle to this, but I'm reflecting on the threats from President Trump to NATO and his very apparent ire that US allies have not stepped up and intervened as much as he would like. Above and beyond what happens with this conflict, is there a risk to NATO at this point? Is this the Trump administration that looks back on this 6 months down the line and says, do you know what, we're done?
No, because this is something that I've stressed from the beginning. Trump faces constraints. They're the interests of a president and the core interests of the United States. NATO is a massive asset to the US. No other geopolitical rival has such an alliance. It makes the US stronger. And when you look at all the threats that Trump has made against NATO, they never came to anything because ultimately he knows that NATO is very important to the US too. And when you look at the defense law that was passed in December in the US, there are lots of commitments to NATO. So this is also why he was never going to really invade Greenland. Ultimately, NATO is a US interest, and he can say a lot of things. He's not going to walk away from that.
And where does China sit in all of this?
China sits at this and looks, wow, this is interesting. This is an interesting opportunity, especially you're talking now about the renminbi being used for transactions.
Yeah.
You know, when you look at history, there are signs of empires that are rising and are declining. And one of the signs of an empire in decline is that its status as a reserve currency starts to deteriorate. It happened to the Dutch, it happened to the Brits. And now the question is, are we seeing the beginning of this to the US dollar because of what's happening in the Strait of Hormuz? So clearly it's allowing China to look like the trustworthy party in the room. And that is what is a game changer. It's about trust. And this is something that the US has eroded by not looping in the partners, by not looping in the allies. And China is capitalizing on this. So I think that obviously they do not like economic disruption because China needs economic stability. But ultimately, from a geopolitical perspective, I think it benefits China.
I want to get your view on what's happening in terms of Russia's involvement with Iran, with reports that they're supplying not just intelligence but hardware now as well to Iran in the form of drones and other equipment for the Iranians to pursue that conflict. Does the Trump administration respond to that? They've typically been remarkably kind of pliant when it comes to Russia. They want to get this deal between Ukraine and Russia. Now reports that Russia is supplying intelligence and hardware that could be used against US military personnel. Does the US see that as a red line? Does it change the relationship between Washington and Moscow?
No, because again, there is very little leverage that the US really has against Russia, or at least there's little leverage that Trump wants to use. Like, for example, we never expected we expected that at one point the Trump administration, after the midterm, would impose much more stringent secondary sanctions on Russia once they realized that Russia wasn't going to back down. Because they didn't want to have high oil prices, they didn't do this earlier. But they wouldn't have attacked Iran if they would really care about high oil prices. So why have they not imposed already secondary sanctions on Russia? So there is something that is holding the US back from taking a tougher stance on Russia, and I don't think this is going to change now.
Anna, really smart insights. Thank you very much indeed. Anna Rosenberg, Head of Geopolitics at the Amundi Investment Institute. Coming up, we're going to go to France to look ahead to the G7 foreign ministers meeting. So more, of course, in terms of response to the conflict in the Middle East as the group seeks to narrow their differences over the war in Iran. That is next. This is Bloomberg.
The role we can play is by not being involved in this war is to actually, both on the diplomatic end, to support the United States in the negotiations and also to reopen, which is really absolutely crucial for the world economy, the Strait of Hormuz.
That was French Senate Foreign Affairs Committee Vice President Hélène Conway-Mouret speaking to Bloomberg yesterday. The wars in Ukraine and Iran, of course, expected to dominate today's meetings of G7 foreign ministers in France. Ministers from Kyiv, India and Saudi Arabia are expected to join the talks as the group tries to narrow its differences over the Middle East war. Bloomberg's chief Europe correspondent Oliver Crook joins us now from Vaux de Sarney. Ollie, how deep are the divisions within the G7 at this point?
So opinions differ, but the headline is the same across the G7 and many nations, which is this is not our war. This is not something that the Europeans or many of the other G7 members are willing to take a kinetic or active military role in. It's something that we've heard the Trump administration call for periodically, not in a very specific manner, but basically trying to get the help from some of these allies to reopen the Straits of Hormuz. And the answer across the board has been we do not have appetite to do so. In normal circumstances, a G7 meeting might be a place for leaders and for foreign ministers to discuss potentially coordinated action, potentially, let's say, on oil strategic reserves. We're not in ordinary times. So for many of the people that are here, the foreign ministers of the G7 and the wider group, it will really be a fact-finding mission for conversations with the U.S. Secretary of State, Marco Rubio, who arrives here tomorrow. They will be trying to figure out what the U.S. war aims are, how they see the war developing, what the next steps are, and of course trying to keep the United States on side on a number of key issues for the Europeans, including Ukraine, potentially putting forward some of the reporting we've seen recently about the Russians sharing intelligence with the Iranians, sharing potentially drones and hardware. That will be the message that the Europeans are pushing. But I think here also there's going to be a degree of conversation among G7 allies on where exactly they stand and what help they can provide to the United States and what help the United States is actually asking for concretely.
Well, yes, we're more than a year into President Trump's second term, Ollie. Is the G7 still a relevant format?
I think that's a very valid question. I think that for the last year, the Trump administration has effectively been trying to invalidate structures like the G7 of multilateralism. And if you think back at the origin of what the G7 is, and really the echoes of history here are really sort of bizarre to consider, that the first G6 meeting was held in Rambouillet, not far from here, and it was to deal with two major crises across the globe. One was the collapse basically of the international monetary order, Bretton Woods, and then the second was an oil crisis instigated by OPEC blockading countries that support Israel. Fast forward 50 years, we're dealing with many of the same issues here. The difference is that back then, the communique, the Declaration of Rambouillet, the antidote to many of these issues was more open trade, more multilateralism, more cooperation among nations to sort of grow the economy across the world. And now we have a Trump administration giving the exact opposite direction. So really, I think it's interesting to come back to the place of birth of the old international economic architecture to find out if it is still valid or if it's here that we bury it.
Ollie, on that point, how do we expect Marco Rubio to approach this meeting? He's seen typically as being more in the form of a traditional diplomat, the US's chief diplomat, versus a J.D. Vance, for example. But have the dynamics changed? How do we expect Rubio's relationship to play out in the coming days with his counterparts?
Well, I think where the Europeans and a lot of in the international community rely on Marco Rubio is to bring kind of substance and also detail to some of the sort of broad strokes that we get from the Trump administration. So I think for many ministers who will be carrying meetings with Marco Rubio, again, it's trying to find those facts to get a clear idea, A, of what the war aims are of the United States, how they're going to achieve those, though it's probably not terribly likely that they'll give too much information on that, given that none of the G7 were really alerted to this invasion before it happened. But again, I think also getting a clear idea of what kinds of things, what kinds of support the G7 can lend to the United States, potentially in the day after, in order to win back the United States on side. And again, I think that for the Europeans, the absolute colossal point here is going to be keeping the Ukrainians on the agenda. We should say that the Ukrainian foreign minister will also be present in these talks and talking to G7 foreign ministers.
Bloomberg's chief Europe correspondent Oliver Crook there. Thank you very much for that coverage. And indeed, oil traders are passing both what they're seeing in the Middle East and what they're seeing in Ukraine when it comes to the oil price. We're up at $106 a barrel on Brent now, up 3.8%. But let's take a look at what else we're watching throughout the day. We do have that G7 foreign meeting. We also have the EU Foreign Affairs Council meeting. We have the OECD interim economic outlook. Before at 12:30 p.m. London time, we get US jobless claims and then a raft of Fed speak as well. We'll hear from Cook, Myron, Jefferson and Barr. But let's bring in Skylar Montgomery-Comic now from the Bloomberg Markets Live team for a bit of analysis. I mentioned the Brent price, Skylar. It feels like we're back in that pessimistic mood heading into the weekend.
Yeah, absolutely. And I think the question that I had yesterday was whether or not we could just kind of like toddle along in markets if we didn't get any new headlines or we just didn't get a deterioration in sentiment. And the answer is clearly no, in terms of we haven't had anything really change over the last 24 hours, I don't think, but you've had that Brent price rise on the idea that heading into the weekend, the risk of escalation is higher. And we've seen this repeatedly over the weeks where people don't want to take risk into the weekend because they're unsure of what's going to happen. And you get more optimism at the beginning of the week as a result. And I think that tells you that we're not quite happy with this peace push that's being put forward from Monday, particularly that the Brent price is now above any level that we've seen this week. And there is still concern there. That means energy prices will rise and stay elevated.
How closely correlated are high oil prices with higher yields at this point?
I mean, I'd say fairly correlated. I think, though, what you're looking at in terms of fixed income is a higher floor on that, right? Because we've already had some permanent damage. If you think about what a 10-year yield is, it's essentially what your policy expectations are plus a term premium. Now, policy expectations, there's already been a change. The Bank of England was supposed to cut in March. They didn't. We're clearly having a more hawkish turn. To what extent that's validated, we know it's a higher floor. In terms of term premium, this is something
that higher floor, because this is really important.
Yeah.
You get a higher floor, there's implications across asset classes as a result of that, and that's your expectation. That doesn't snap back in the event of an end to this conflict. That higher floor is now kind of structurally in place, at least in the kind of medium term?
Yeah, I mean, absolutely. And
Right.
I think particularly for your fixed income outlook from central banks, they're really worried about inflation. And if you look at something like the gas curve, there's been enough infrastructure damage that curve is elevated across. So you're getting at higher prices in gas as expectations for the end of the year. And from a term premium perspective, this is really important. This is the fourth supply shock we've had in almost as many years. That raises economic uncertainty. It means that your bond equity correlation turns positive. So bonds aren't protecting you in the same way that they have historically. And you also are getting more supply, whether that be to fund the war or in energy subsidies, etc. Now that justifies a higher term premium. And I think investors are increasingly being aware of that as it's just not going away, right? Geopolitical frictions, that kind of stuff means we're getting more of these.
Skylar, isn't it weird that the Stock 600 and the FTSE 100 are both down 0.9% when we've got oil flirting with $106 a barrel, it's just below that now, and so much energy exposure in London?
Yes, this I think is going to correct itself. I think part of it is the market's looking at who's an energy importer, who's an energy exporter. So the US is a clear beneficiary of that despite having a relatively low weight of energy within its equity index. Now that makes sense they just have lower input costs, so that'll be positive generally just with WTI being lower than Brent significantly. Now for the UK versus Europe, part of it's the energy exposure is better in the UK, so higher. Also there's just worse energy exposure in Europe, as in materials, industrials, that kind of stuff that has higher input costs. Are also there, and then the UK index is also more defensive. So maybe it's that exposure, maybe it's the yield move, but what we saw in 2022 is this massive outperformance of the FTSE versus the Euro stocks. Now that partly is also because they were able to expand margins in this more inflationary kind of economy that is the UK, and I'd expect that to kind of repeat itself this time around. So you'll get more kind of divergence and people looking at stuff more specifically as the crisis continues.
Skylar, thank you, as ever. Scarlett Montgomery-Koning from the Bloomberg Markets Live team as we look at European stocks down about 0.8 across the benchmark right now. Kai Kallas, meanwhile, EU Foreign Affairs Chief, will be speaking at 4:30 p.m. London time. That interview very much worthy of your attention. Of course, that is it for the opening trade from me and Lizzy. The Pulse is up next. This is Bloomberg.